Welcome to MasterMind Minutes, the podcast that focuses on the franchise industry. We'll cover topics that are important to franchisees as well as franchisors and share interesting insights that will help you build your business. We have one guest, we ask one question, and we do this in minutes, not hours. Good morning. Hello again. It's Gary Occhiogrosso. I'm the founder and managing partner here at Franchise Growth Solutions, and also the publisher of FranchiseMoneymaker.com. And I want to welcome you to MasterMind Minutes. For those of you who are new to the program, it's a pretty simple concept. We have one guest, we ask one question, and we get an expert answer, generally speaking in minutes, not hours. So if you're on the treadmill or doing what you do, guaranteed this will not last hours and you'll have some good information. Of course, we always realize that it may not be enough time to really inform you on the topic. So at the end of the program, we will give you the contact information of our guest, and you can feel free to reach out and have a broader conversation. And today, my guest is Sean Whitehead, who I know for several years now, actually was one of our panelists at the New York Franchisor Forum. And he is the vice president with NewSpring Franchise, which is a private equity firm focused on investing in and growing innovative franchise and multi-unit concepts in the lower middle markets. And we'll have him explain that, different various markets. He's responsible for all phases throughout the life cycle of the deal, as we say, leading new deal sourcing, transaction, execution, and ongoing operational support to the companies that are in their portfolios. So I'll have Sean explain a lot more about that. Sean, thank you very much for being with us today. I truly appreciate it. I know we've been trying to hook this up for a while. Before we get into the question, why don't you tell us a little bit more about Sean and a little bit more about NewSpring Franchise, because I know there's a bunch of verticals that NewSpring is involved in, and why don't you tell us all about that, and then we'll get into the question.
Yeah, absolutely, Gary. Thanks for having me. I'm from Philadelphia. I'm with NewSpring Franchise, been with the firm for a little over 6 years now. NewSpring Capital as a whole, like you said, it's a family of funds. So it's got 5 different strategies, has been around for about 25 years now. When I first started, it was only 4 strategies. We focus on growth equity in the technology sector, mezzanine debt. We have a holdings buyout fund, and we have a healthcare fund. Almost 5 years ago now, my 2 partners, Pat Segru and Satya Panaru, saw this need in this hole in the lower middle market, and I'll explain what that means to us, because depending on who you ask, it can mean something different for franchise and multi-unit businesses. To us, the lower end of the middle market is sub $6 million of EBITDA. Now, where we differ from most firms is, we're actually okay going below that magic $2 million EBITDA number. A lot of founders that I talk to are below that threshold. But my partners, Pat and Satya, saw a hole there where these brands need some guidance, some expertise, and whatnot of a private equity partner, and obviously some capital on the balance sheet. But they just weren't yet meeting that $2 million EBITDA threshold. So almost 5 years ago, Pat and Satya decided to fill that hole and join the NewSpring family and start NewSpring Franchise, where we invest in franchisors, franchisees, and company-owned models. Really looking for emerging brands to help grow them and provide not only that financial capital, but some human capital and intellectual capital as well. Focusing half on restaurants, primarily in the fast casual space, half on in the broader consumer service space.
Great, and that's terrific. I will tell you that, having been around this space, this game, whatever you want to call it, for a whole bunch of years, I can tell you we've done business. One of the verticals in our company in Franchise Growth Solutions is private equity introduction for deal flow. And the reason we got into that is because many of our clients who are emerging brands, as some of the people we work with, they can get to a certain point and then they need a capital infusion to kind of get up above that. Well, for years, we were frustrated with the big guys
who, hey, don't talk to me if I don't see a $5 million EBITDA line. Like, so there were very few people to make those introductions to, other than what I will call the VC sharks, who would want to come in and basically, do a bloodletting on the
Yeah.
founder of the company, and we didn't think that was the right thing. The other piece was they weren't sophisticated in the business itself. So I think what's unique and what I've seen happen now over probably since COVID, what I've seen happening, and I think NewSpring, in my opinion, in the business is the leader in the space, is sort of swimming further upstream to look at those emerging brands and those opportunities. And what I've seen is, again, and I always preach and teach this, is look, there's 100 companies out there that could write a check.
Yeah.
You need more than a check. You need some strategic partnership. You need guidance. And I think from what you've just said and from what I know about NewSpring, you guys are actually bringing some level of intellectual asset to the table, not just financial. And that's what emerging brands truly need. In addition to the money, they need to understand how they grow, how they scale. And if you've got a portfolio of brands where you've been there, done that, that's obviously a very helpful piece to emerging brands. So that's great to know. And I think that's probably one of the what do they call it? The jewel in the crown of
Yeah.
NewSpring. I don't know anybody else that's really doing it on the level of NewSpring.
Yeah, yeah, no, you nailed it. Whether it be through our shared service platform, or our value creation network of individuals, or something that we take pride in is one of our founding partners, Pat. He spent over 25 years in the C-suite of franchisors, so he sat in the seat of our CEOs, and it can be a lonely seat. So he's experienced those ups, those downs, and can help our brands
Yeah.
work through them.
Yep, yep. All right, let's get into the question. I'm going to sort of pre-frame this. A couple of weeks ago, it was probably 2 or 3 weeks before IFA. I had Bob Tobias on, who's got I wouldn't call him a private equity investor. I wouldn't call his company private equity in the true sense of the word. It's a little bit different. Um, for those of you who are now curious that I've mentioned it, go back and watch the episode. I need the views. Okay. So, but what we were talking about a lot was sort of the different paths now that private equity firms are taking. Like NewSpring's a great example. I mean, as I said, 5, 8 years ago, nobody would talk to an emerging brand. It was like, forget it. Call me when you got 100 units. All right. So I think of those things as trends. Like, where is the space? Where's private equity and franchising? And you all know. And hold on, I'm gonna stand up for a minute. Hold on a second. You all know, because I talk about it all the time. My friend Alicia Miller. I feel like I'm always promoting her book, but it's not like I'm simply promoting her book. I talk about her book a lot because I think if you're a franchisor or in the franchising business and private equity is on your radar, let me get this in the camera here, you definitely want to pick up her book. And she doesn't pay me to do this. I love her and I love what she does and I love this book. So the reason I'm talking about that is that there's been changes in the industry and how private equity and franchising kind of now like get together. I'd love to hear you talk about what trends you see for private equity investing in franchising. I mean, we can't go out 15 years, but what do you see maybe on the 5 year horizon?
Yeah, yeah, absolutely. So, we talked about it a little bit just now, but I really see more of a focus and specialization in the franchise space, especially as you see these, very huge headline transactions happening. With Blackstone, with Tropical Smoothie and Jersey Mike's, and these multi-billion-dollar transactions grabbing headlines, turning heads, are starting to get these other firms interested. But you mentioned in your prior episode with Rob that broadly there really are not a lot of PE players with a sector-specific focus in franchising, so they're lacking that operational expertise to actually add value. Any firm out there can stroke a check, but there's only a certain few that that can really add some value beyond that intellectual capital, that human capital. So as more PE players are entering the space, they're going to need to find ways to differentiate themselves and actually add that value, which means either learning the franchise business or bringing on operational partners that can help them. When your companies and other companies out there are talking to private equity firms, it truly is like a dating experience. And when that transaction closes, you're married. So throughout that dating experience, it's a two-way street, right? So companies shouldn't be the only ones answering questions. They should also be asking questions of their prospective partner as to what value they can bring. And there's a lot of different things to look out for, and a lot of ways that I think I will see or will see private equity firms trending towards, having experienced operators on their team, having a demonstrated track record of successful growth and exits, shared service platforms, networks of professionals, preferred partnerships and vendors, but not only having those partnerships, but a knowledge of what that tech infrastructure is, and just having a portfolio of franchise companies. That's one of the favorite things of our brands. We now have 7 companies. Is our CEOs are very collaborative, and the value that is added goes beyond the private equity firm, but rather them having their quarterly calls together where they're able to just talk for an hour. What are you seeing? My contract's coming up here. What are you paying? How should I negotiate that? So all of those things, I think you'll start to see private equity firms trending towards to be able to make themselves more attractive to franchise companies.
Yeah, and I think those are very, very important statements. You said something there that sort of it's like a marriage, and both sides should be asking questions. That's not unlike vetting and awarding a franchise to someone. We tell the buyer, hey, you should be asking a lot of questions, which they usually do because they think they're the buyer, so to speak. They don't realize that the franchisor sort of holds the cards. You think they do, but we tell the franchisor you should be asking tough questions also. Now, interesting. The franchisors in our business sort of take on the role of the companies in your business. And what we have found, they're sometimes skittish to ask too many tough questions of the private equity firm because they're afraid of losing the deal. Like they need the deal so bad that they don't want to ask questions. That never really ends up well because, they have expectations and maybe those weren't discussed. And then it becomes, then it becomes an issue. Look, I agree with you. I think, the specialization, as you talked about, I think that's really important. One of the things on that trending, what I'm seeing, and maybe you can talk a little bit about this, is I'm seeing some private equity firms that sort of gravitate towards the service business, the non-bricks and mortar, what I call lovingly chucking a truck. You find a guy named Chuck, you sell him a truck, you give him a broom, and he's in the cleaning franchise business. Okay, he's in the cleaning business, all right. And then there are companies that they'll do that, but they'll also look at restaurant brands or retail brands. Now, there are some PE firms that when I tell them we're like the big guys in the restaurant space, they're like, go away. They don't want to know us. So what, NewSpring, do you gravitate towards either sector, bricks and mortar service, or is it, hey, if it's a good brand, it's a good brand? What are your thoughts on that?
Yeah, so ideally the way that we want to structure our portfolio is we're trying to mimic kind of the broader discretionary consumer spend, and GDP spend. And if you look at that, about half of what they're spending is on the food space. The other half of what they're spending is just on broader services. So that's how we're trying to mimic our portfolio. Is we want half of our companies to be in the restaurant space, food related, primarily fast casual, and the other half will be in just broad-based consumer services, pet services, home services, personal care, fitness, etc.
Yeah, and that's a good strategy because you're balancing the portfolio, obviously.
Yeah. But you make a very astute observation in that firms, do tend to lean more towards those service brands, and that's another trend that I see is these private equity firms focusing really on resistant industries, not and when I say resistant, I don't just mean recession resistant, but I mean technology resistant, right? So they're going to be looking for brands where technology can be used to enhance the customer value proposition and the unit economics, et cetera, rather than being viewed as an existential threat to the business, right? So there's two different things to look for. a business that's not going to that can't be replaced by AI or technology, and B, a business that is recession resistant. For instance, we have Green Home Solutions is one of our portfolio companies. They do mold remediation and indoor air quality. Um, you know, uh, who knows what's to come, but I can imagine in the near term there's going to be AI or some type of technology that can eradicate the mold in your house,
Right.
right?
A
So,
robot, a robot
yeah,
will show up and paint your living room. I get it.
yeah, but there is ways for that technology to make the experience better, right? Whether it be an automated quote system or an AI call center or a chatbot or technology to identify the mold and monitor monitor your air quality, or sticking with that same company and highlighting the recession resistance. If you have black mold in your house, you got to get rid of it. Otherwise you're going to be coughing and pain, not healthy, etc. So I think looking for those brands, but also when it comes to recession resistance, I don't think it's just what's the cheapest or what who has a value menu. It's really making sure that and investing in brands where there's validation in the perceived customer value proposition by the end customer,
Yeah.
right? So it's not just who's offering the cheapest cheeseburger or who's offering the cheapest fencing service. It's who's doing it the best, who's providing that experience that customers want to go to and find that the dollars that they're spending are worth it.
Yeah. Well, you're preaching to the choir on that, brother, because I'm one of those people that believes if you have a cheap product or if you're competing on price or you're doing the buy one get one, I have this expression. It's a little bit edgy, but I'm going to say it anyway because people expect that from me. It's like once you start with the whole competing on price, that's like the heroin addict that dies with the needle in their arm.
Yeah.
It never ends. It never ends. And that's not really, I think, the value proposition. People are willing to pay for value and good product service. It's interesting what you say about the different sectors and the sort of the technology resistant to a certain extent. I know this guy that owns a shopping center, big shopping center down in Edgewater, New Jersey. And look at that, my phone's ringing. It never stops. So let's just do that and kill it. Okay, so um, anyway, he once told me because he was sort of rotating tenants, and I said to him, his name is Ari. I said, "So Ari, like, what's your tenant mix?" He goes, "I'm never putting anything in my shopping centers that you could buy on Amazon." And I'm going for, physical fitness places, the walk-in medical joint, the full service restaurant, the thing that people have to come to
That's
because
right.
you can't do that because you can't do that online.
Yeah.
And it's sort of the same thing what you're saying, you want to look for businesses that have some level of human engagement that can kind of weather sort of the learning of technology and not be completely wiped out by them.
Yeah. Yeah.
I think that's seriously important. So with that sort of as a backdrop, what would be some of the things again, looking at what's trending, what are some of the things that you look for when you're looking to invest in a company? What are some of those things?
Yeah. So depending on what the business model is that we're investing in, whether it's a franchisor or franchisee or a company owned model, it can vary slightly. But there are a few key items that we look for. One is, and you'll understand this more than anybody, is proven unit economics. When it comes to growing the business and you're a franchisor, the pulse of your system is growing your franchisee base and your unit count, right? To do that, franchisees outside of there are perhaps a couple passion plays and passion industries. perhaps in the pet services space, somebody's just very, in love with pets and helping them out, and perhaps isn't in it, solely for the money. But by and large, franchisees are in it to make money, right? Whether they're buying themselves a job or they're trying to create generational wealth. So the most important thing to check out is that unit economic model, making sure it's sustainable, making sure it's proven out, making sure it's portable. When franchisees make money, it answers a lot of questions. And look, there's always going to be headaches for a franchisor, but not having to deal with that gets rid of one of them. So really focusing and making sure it's a strong unit economic model is crucial. Franchisee validation is very important for a franchisor, right? Making sure that the franchisees are happy, and that goes beyond just making money. We want to make sure that the franchisees feel like they're getting value for what they're paying for, right? Because they're paying you 5%, 6%, 7%, up to 10 or 12% royalties. If they're not happy with that, when that agreement runs out, they're gone. And you'll start to see a shrinking system pretty quickly.
So how does, not to interrupt, I'm sorry, but because I think the whole franchisor relationship piece that you're talking about right now, how does private equity typically impact that? Like, do franchisees go, oh, now we're going to be owned by the corporate suits and the founder is gone, or do they embrace that? Are there situations where the founder is maybe collecting and neglecting or not capable of supplying service that they go, oh, great, the cavalry is here, somebody's, what's that relationship like? I realize it's different in all cases, but generally, what are some of the common things that you see as impacts on the relationship once private equity is in the picture?
No, that's a great great question, and it's all about A, the messaging, B, being transparent, being very transparent. As word spreads very quickly across franchise systems. So being transparent is crucial, and understanding that it's going to be a learning and teaching moment, right? It's you're not, as a private equity partner, you're not just selling yourself to the founder. Once that transaction is getting ready to close and closes, you're also selling yourself to the franchisees to do away with those fears, right? It's showing them how you are going to add that value, what will be changing, what won't be changing. But most importantly, what they want to know is that the culture of the brand is going to remain intact, right? So making sure that you're expressing that's important and calms a lot of fears, and then just showing them what value you're going to bring to help them grow. Because again, at the end of the day, they're likely in it to make money. So if you're in there and telling them how this partnership is going to perhaps make them now have national partnerships or a better digital marketing program, better lead generation, better brand recognition, really being able to expand that national brand fund on a true national level, rather than just kind of more regional marketing, they're going to be signed up pretty quickly.
Yeah. Well, I'll tell you personal professional history story quickly. In a past life, recent past life, like from 2008 until 2015, somewhere around there. I was the president of a company that was we were embedded in a family office, and we were on the buy side of franchise brands. Now, we had a different approach to this. We were buying what we would call heritage brands, which were basically brands that were beat up. And but we were always on that topic of the franchisee and private equity and franchisor. And we were more franchisors, but we were backed, okay? But the interesting thing was, if the brand had franchisees that loved the company, were really prosperous and loved the founder and loved what they were doing, we now had to live up to that. And if they were companies and franchisees that were neglected, or the franchisor maybe abused them or whatever, now we had to sort of get their trust. So we were always on the hot seat on one end or the other. It was never a win. It was always okay. They love us, or they love the former guy. We now got to be better. Or they hated the former guy, and now we got to show him that we're different. And that was the biggest challenge, because if you can't get the franchisees on board, you can't grow because you can't get validation. So I hear you on that. That's for sure. Talk to me a little bit about um, exit strategies. We're kind of getting to the end, but we're not. I'm not asking you for your last thoughts on this, but I would like to know, when a firm like yours comes in, and let's say you buy I don't know, a 50 unit brand, okay, and I'm anticipating that would be in your sweet spot, a 50 unit
Yeah,
brand,
absolutely.
good unit economics, good EBITDA on the franchisor side. Z's relatively happy. No one's ever completely happy. What do you like? What's your plan? What's your strategy? Is it a buy and hold, buy and sort of really build it up to maybe it's 200 units and flip it? What's sort of your exit strategy?
Yeah, absolutely, absolutely. So, when we're partnering with brands, we're typically backing founders and and the existing management teams. So we're backing them to help them through that next phase of growth. Like you said, our sweet spot's typically in the 25 to 100 or so unit range. We can go below, go higher, but that's probably our sweet spot. And a lot of times, as you know, there's a lot of what seem like dead ends, but are more just hurdles to get through. The first hurdle is a successful first unit, and then the second hurdle is unit number two. Third is maybe number 10. Fourth is 50, and then getting to 100. There's only a very small percentage of brands that can get to 100 open units.
Absolutely. Yeah.
Right. So the owners and management teams recognize that, and recognize that they need help, and I ideally where they need that help, right? So it's coming in, like you said, at that 50 unit mark, and bringing them hopefully 200, 250, 300 units. There's no kind of set threshold or number there for us. We're typically holding in a 3 to 7 year period. So it's not, we're not a true buyout shop. We're not an evergreen fund that holds forever. Ideally, we are taking them to that next phase of growth because, similar to the founders who, eventually reach their capacity or the limits of their skill set. There are better buyers out there to take units, to take you from unit 300 to unit 1,000, right? And it's recognizing that, getting you in a position to have what that next buyer would be looking for, and being able to continue to effectuate that growth moving
Yep.
forward.
Yep. And it's interesting because every firm obviously has a different approach to this. I remember at the New York Franchisor Forum that we did in November, you were on the panel that Alicia, I'm not going to hold up the book again, conducted, but I recall she used Tropical Smoothie Cafe as one of her examples. And, a lot of people obviously heard about the big deal, the double digit billion, whatever, because it's like, how do you avoid that? But what she brought out was that I think that company was actually invested in and exited 3 times or twice before it got to the final billion-dollar deal.
Yep, that's right.
So I think that's what a lot of franchisors don't understand. I think, first of all, too many people are watching Shark Tank, and they forget that it's a TV show. No disrespect to Shark Tank, but it's not, hey, we go from 0 to 15 billion in 5 years. I mean, that's in the movies, man. It's in the movies. Okay.
Right.
So if as a closing thought, with that kind of in mind, and what advice would you give franchisors who are considering private equity or would like to attract private equity? Like, what can they do to sort of, polish the apple? What is it that you guys are looking for, and what can they do to make their businesses more attractive to private equity?
Yeah, absolutely. So I'd say, again, having that proven unit economic model. I would say having a good blueprint. It obviously it's always iterative and it's always a work in process, but having a good blueprint as to what your operation and training manuals are for your franchisees is important. And outside of those kind of quantitative things, and there's a few others, but outside of those, I think looking internally and thinking, A, why do you want a private equity partner? B, why is now the right time for you? And C, what does the right partner look like to you? Where are they going to help you? Where are you having the most problems? And what are the holes in your organization? That's really going to help you pick your partner, and you'll be able to picture what your partner looks like in your head before you even meet anybody.
Yeah.
And then once you meet them, it's going to click.
Yeah, I think that's an important point. I'm glad that we're sort of closing on that point. Relatable to us when we deal with franchisors who want to come on board with us. We're sort of, they all want to know, oh, how many can you sell and what? And our thing is, you know what, we won't know until we're actually in front of people, finding out where the holes in your system are from a market perspective. Like, this is what people think. So to your point, a franchisor should probably start to talk to people like you in advance of actually maybe being
Sure.
ready to find out, hey,
Yeah.
you know what? You need to, it's like when you sell your house, the real estate guy comes in and goes, you got to stage this, you got to declutter.
Yeah.
You can give them some advice. So that's great. Sean, listen, I got to tell you, I could probably talk about this all day with you, but kind of defeat the whole mastermind minutes thing. We got to have you back. Thank you very, very much for being with us. If somebody wanted to get in touch with you directly or NewSpring, what's the best way for them to do that?
So visit our website, newspringcapital.com. I believe you'll have it linked and a QR
We
code
will,
available. Yep. And if you want to reach out to me directly, swhitehead@newspringcapital.com. Always happy just to chat. If you have any questions, just to walk you through things. It is a relationship business like many things, and I'm just always happy to catch up with people.
Great, great. Well, thank you again for being with us today, and I look forward to seeing you at additional conferences and other things. And we're having another forum in May, and certainly you're invited. And I look forward to seeing you in person again. Be well.
Always, absolutely. Thank you.